Oil is more than just fuel. It powers cars, ships, planes, factories, farms, and even the products sitting on supermarket shelves. That's why, when oil prices suddenly rise, the effects go far beyond the gas station. A sharp increase in oil prices can push up the cost of almost everything: food, electricity, transportation, and manufacturing. In other words, oil price shocks can trigger global inflation. But how does one commodity have such a powerful impact on the entire world economy? In this video, we'll break down what an oil price shock actually is, why oil prices jump suddenly, how those increases travel through supply chains, and how they end up raising prices everywhere. Let's dive in. What is an oil price shock? An oil price shock is a sudden, sharp change in oil prices, usually upward within a short period of time. It can happen because of wars and geopolitical crises, supply cuts, sanctions, shipping disruptions, or unexpected surges in demand. The key word here is shock. It's not a slow trend. It is a rapid shift that markets weren't prepared for. Historically, oil price shocks have been linked to major inflation waves, recessions, and financial instability. Why oil prices move so fast? Oil is traded globally, and its price is shaped by expectations as much as physical supply. Supply disruptions if major producers reduce exports because of conflict. Sanctions or technical failures, global supply shrinks quickly. Even if the shortage is small, oil markets can panic because demand for oil is highly inflexible in the short term. OPEC decisions, the Organization of the Petroleum Exporting Countries, along with major partners, often referred to as OPEC+, can cut or increase production. When production is cut, oil prices usually rise sharply. Geopolitical tension, the world's most important oil routes, like the Strait of Hormuz, can become risk zones. When traders fear disruption, prices can surge even before oil shipments stop. Demand surges if the global economy recovers rapidly, like after a recession. Demand for transport and production rises, lifting oil prices. Speculation and futures markets, oil prices don't only reflect current physical demand. Traders buy futures contracts based on forecasts, which can amplify price movements. Why oil is the master price of the economy? Oil affects inflation because it's a core input for the entire economic system. Think of oil as the fuel behind transportation, logistics, manufacturing, electricity generation in some regions. Agriculture, production and distribution. Plastics and chemicals. This means oil does not just affect energy costs, it affects the cost of making and moving goods. That's why oil shocks spread like dominoes. The first wave, direct inflation. The most immediate impact happens directly through energy-related products. When oil prices rise, you quickly see higher gasoline and diesel prices, more expensive airline tickets, higher shipping costs, increased heating oil prices. This is called direct inflation because consumers see it immediately. But that's only the beginning. The second wave, indirect inflation through supply chains, oil price shocks, create a second wave. The rise in production costs. Transportation and logistics, almost everything is shipped via trucks, ships, trains, airplanes, all depend heavily on fuel. When diesel prices rise, delivery costs increase. Businesses pass those costs to customers. Manufacturing factories use oil-related energy and inputs. Many products require petrochemicals, plastics, synthetic fibers, packaging, industrial chemicals, so oil price rises increase the cost of materials. Food inflation. Food is deeply connected to oil. Oil affects farm machinery, fuel, fertilizer production, irrigation systems, transportation, and refrigeration, so higher oil equals higher food prices. That's why oil shocks can turn into global food inflation, especially in import-dependent countries. The third wave, inflation, expectations, and wage pressure. This is where inflation becomes dangerous. If oil price increases persist, consumers and businesses start expecting higher inflation in the future. When people expect prices to keep rising, behavior changes. Workers demand higher wages. Companies raise prices more aggressively. Suppliers renegotiate contracts. Renters request higher rents. Banks raise interest rate expectations. This creates a self-reinforcing inflation loop. Economists call this inflation expectations becoming anchored. Central banks react, and that can trigger a recession. When inflation spikes due to oil shocks, central banks face a difficult decision. If they do nothing, inflation spreads, purchasing power collapses. Currency confidence weakens if they raise interest rates aggressively. Borrowing becomes expensive, investment slows down, unemployment rises. Economic growth declines. This is why oil shocks often lead to stagflation. High inflation plus weak growth, the 1970s oil crises are the classic example. Oil prices surged, inflation exploded, and growth stagnated for years. Why some countries suffer more than others? Not every country experiences oil-driven inflation equally. Oil importers versus oil exporters. Importers most countries face rising costs. Exporters may benefit through higher revenues to currency strength matters. Oil is priced globally in US dollars. If a country's currency weakens against the dollar, oil becomes even more expensive. That's why oil shocks can trigger currency depreciation, higher imported inflation, balance of payment crises, 3 subsidy policies. Some governments subsidize fuel prices. This can reduce consumer pain temporarily, but it creates budget deficits, debt pressure, long-term fiscal risk. Eventually, subsidies become too expensive to maintain. The global ripple effect. Oil shocks don't stay local. Shipping costs and global trade. When oil rises, shipping becomes expensive. That affects container freight rates, international trade costs, pricing of imported goods. Financial markets react. Higher inflation expectations push up bond yields. Stock markets often fall because profits are squeezed. Interest rates rise, consumer demand weakens, rising risk of political instability. History shows that high energy and food prices can trigger protests, political unrest. Rapid policy changes, oil shocks, have contributed to social tension in many countries over the decades. Can the world reduce oil inflation risk? In the long run, yes, but it's difficult. Solutions include strategic petroleum reserves, diversified energy sources, faster expansion of renewables, energy efficiency policies, improved supply chain resilience. However, oil remains deeply embedded in global infrastructure. That means even with green energy growth, oil shocks can still cause inflation, especially in transport-heavy economies. Oil price shocks are more than an energy story. They are inflation shocks. When oil rises sharply, energy prices jump immediately. Supply chain and production costs increase. Food prices rise. Inflation expectations spread. Central banks tighten policy. Growth slows, sometimes into recession, and because oil is traded globally, an oil shock in one region becomes inflation everywhere. So the next time you hear headlines about oil prices surging, remember, it's not just about fuel, it's about the cost of living around the world.